Well, let's welcome on board a very special guest right now, Punita Kumar Sinha. She's the managing partner at Pacific Paradigm Advisors, also the chairperson InCred AMC. And remember, Punita also managed one of the largest India-dedicated mutual funds in the US for almost 15 years prior to her current profile. Punita, hi, afternoon. Good to have you on the show. So perhaps then you're the best person to really analyze and dissect SEBI's latest reclassification of multi-cap funds, Punita, because what one is wondering is whether this is really the big bazooka moment for small and mid caps or not, because it doesn't seem to be the case, especially after the Sunday night clarification coming in by SEBI pretty much putting the ball into the mutual funds courts to try and reclassify the nomenclature for multi-cap funds, keeping the unit holders as the priority.
Well, Aisha, I mean, from my experience in the US and having run an India dedicated fund, we had no such restrictions. Everything is laid out very clearly in the prospectus. And if a fund says that it's a focused fund, or if a fund says that it's long-term capital appreciation, which mine did, then you have a total flexibility within the rules that you have laid out for investors in your prospectus. So the investors know exactly what they're getting into, and it isn't that the regulator is putting all of these restrictions. So if you look at all the all-cap focused funds in the US mutual funds, they can allocate between large cap, mid cap, small cap, any which way they like. They can run a concentrated portfolio across all caps. And the decision to allocate is pretty much left to the professional judgment of the fund manager. Because if you artificially put these restrictions, then you don't even have the right benchmark. So let's assume for a minute we put this 25, 25, and 25. There is no such benchmark, right? Even in India, that has 25, 25, 25. So what is this manager going to be measured against in terms of their performance? In fact, you're going to have huge deviation, perhaps even more than you would have otherwise. And you wouldn't even have a good investment rationale for allocating the way you do. So while this is obviously going to help small and mid caps because it will force more money into an overlooked sector, I mean, most often it's overlooked. But it doesn't really help the investor in the end, because the mutual fund investor is going to not get the best returns long term and not get the best judgment of the professional manager that they've given the money to.
Sure. Well, it's anyone's guess, Punita, whether this decision by the regulator is going to be rolled back or not. But what you're saying is tactically, if one is getting excited about, this being the mega re-rating moment for small and mid caps, that's not going to be the case?
No, I think if the rule goes into effect, obviously it will help small and mid caps. And even if you look, globally right now, if you look at a lot of all cap funds, I was just looking at their allocations prior to our call, and most of them are allocated to large caps. So if you look at some of them, they're allocated, some of them have one fund had like 23% in Amazon, and this was an all cap fund. So there is, even in the US right now, most funds have been allocated towards large caps. And that always happens in a period of crises. Now, as the economies recover, which we are beginning to see, then the shift to mid and small cap happens. And while there is more value in mid and small caps as compared to large caps, that shift has just begun. But this, if it goes into effect, will propel that shift in a big way.
Sure. Absolutely. The point that you were making, and I was chatting with Jonathan Shizel as well just a short while back before you came on board, that it's the polarized nature of the market, which is great in a way if you're invested in those names. And this is a phenomena globally that's happening as well. It's the big tech five, the FANG names, where the concentration of money is. And that's exactly what's happening back home as well. Be it the IT sector, IT perhaps, is one standalone case where you're seeing just about every stock hold up, at least right now. But, Reliance, IndiaMart, within the rules theme as well, and Escorts, and I can go on listing out examples. Do you think this monotony and this concentration of money is then going to break with this rule coming into place come January 2021?
Yeah, I mean, I think there must be something that's forcing the regulator to come up with this rule, perhaps some mis-selling, but it's not really required because you're compromising on returns. Because if the assume for a minute in March and April, if you had this rule, the fund would have underperformed in because large caps outperform mid caps, and if the investment manager believed large caps were the place to be in, but you've artificially put this allocation rule, then they would have had to have money in companies and stocks that corrected more sharply. So I think this judgment has to be left to the fund manager because that's what you're paying them for, is to make the decision on finding the best stock. And that could be a large cap, that could be a mid cap, that could be a small cap, and in a multi-cap fund, or what they call in the US an all-cap fund, that that's the attractiveness of these kind of funds. So, for instance, when I was running the India fund, at certain points in time, we had much larger allocations to small caps and mid caps, and while other periods of time, maybe we didn't. So, in the tech boom in 99, 2000, we had huge allocations. At one point, our portfolio became 40% technology because technology really ran up a lot. And that included some mid-cap names like NIIT at that time, which became very large. Now, if you have this rule, you'll be forced to allocate out of some of these companies that have really been your winners, even if you see more potential in them. And it'll be very difficult for the fund managers. And as I said, you're creating more benchmark risk, right, for investors and for managers, because there is no benchmark in India, any index in India that the manager can then say, this is my benchmark, because there's no benchmark that has this allocation mix, right? And also, I think it will favor investors to invest in global India funds, which have more flexibility, or to invest in AIFs and PMS, which will not have these rules. So the AIFs and PMS could launch all-cap funds, and investors would perhaps find them more attractive without having these restrictions.
Yeah, makes sense. But as a market observer, Punita, where is it that you're seeing value? Because, the large is only getting larger and the smaller ones are clearly getting left out of the race, or, just selling out to the larger players. That's what we're witnessing across sectors and industries. Do you think this phenomena is here to stay, and will the market then continue to assign those rich valuations to these large players in every given sector?
If I start looking at some of these PMS or multi-cap schemes, they recently have started shifting to small and mid caps, and I think there is more value in mid and small caps. If you look at the Nifty valuations and the US S&P 500 valuations, they are pretty much at the levels that they almost at their highs, whereas the mid and small caps are far from being near their highs. So purely on valuation and value, there is a lot more value to the companies and sectors that have been hit in this economy and are probably going to take a little bit longer to recover. And the markets have actually anticipated this recovery or run ahead of the recovery, right? Whether it's in the US, whether it's in India, or in other emerging markets. Stock markets have rallied ahead of the economic recovery and in the hope of an economic recovery. And if that recovery comes, then the valuations are much better in the mid and small caps. So that shift would have automatically happened from large to mid and small by fund managers in their professional judgment. I think right now is one of those times where the concentration in large caps has gotten even bigger than normal. And as I said, if you look at some of the US funds, they have got all their top 10 holdings are mostly all large cap names. There is hardly a mid and small cap name, even in any portfolio there, other than perhaps one small name. So this is a global phenomena that, there has been a concentration towards the bigger names.
Punita, now that this rule has been put in place by the regulator, where do you see buying within mid and small caps? And what's looking interesting? Because like I said, it's those few sectors which are holding the rest of the market. So do you think it'll be bottom-up stories within the usual suspects that one would look at first?
Yeah, I think it will be bottom-up stories, and I think sectors where there has been more pain, which are now likely to recover as the economy recovers, and that's probably going to be in consumer discretionary, auto components, autos, some still healthcare names, which are obviously good long-term secular plays, some IT mid-cap names as well, because even in IT, we've seen a large concentration towards the larger cap names. So I think it's going to be very stock specific, and there is enough to pick from because India has a large number of mid and small cap names. So it's like a huge universe to pick from. And in fact, as I was attending a conference last week, India conference, most of the companies, and these are mid and small caps as well, saying that their activity levels are back to pre-COVID levels. So that was pleasantly surprising because that means companies are beginning to see some kind of normalization. But of course, there are some risks still that remain. COVID is still very much a risk. So I do worry that the valuations are not cheap generally anywhere in the world, particularly in the US. And so, if there is one more leg down due to COVID, then the markets could correct. We also, I think inflation is picking up. So that's something to keep an eye on. And then, the fiscal situation and the fiscal health of most economies and most countries is not great because of the stimulus that's been given. So, over a period of time, if that stimulus starts to get withdrawn, then that could also pull the liquidity that's been put into the markets out, and interest rates might tick up at some point. Right now, the Indian government bond yields are almost at 20-year lows. So, I mean, the fact is, can they go lower? Maybe things get worse, but can they sustain at low levels if inflation picks up or the economic recovery starts? Perhaps no.
Fair point. The other thing, Punita, which is making emerging markets relatively more attractive is the dollar weakness that we've seen, although it's stabilized off late. But do you sense in the run-up to the US elections, perhaps the dollar is going to remain weak as opposed to other emerging market currencies and thereby make EMs a lot more attractive?
Well, I think EMs are not more attractive just because of the dollar. I mean, the dollar returns do matter to global investors because they have, while they have made money in local currency when translated into dollars in the past, because of the continuous depreciation of the local EM currencies, they've lost a large part of their return. So to the extent that dollar weakens, it's generally good for EM and it's generally good for commodities. And the US election is definitely playing a part in it. But I think also if you look at EMs, it's not all EMs. Chinese, US and China markets are one of the best performing markets. And even within the US, NASDAQ has been the better performing market.
Sure.
So, countries that had more of the virus early are the ones, ironically, that have performed well. So it's the other EM countries where there is more value as maybe compared to, say, China.
Sure. Okay, Punita, great having you on the show today, and you have a good trip to the US.